All right, let's tackle a huge question, one that's been bouncing around the investment world for years. Can crypto actually save your portfolio when the stock market takes a nosedive?
You've heard the pitch, right? For years, we were told that assets like Bitcoin were basically digital gold, a safe place to park your money, totally separate from the chaos of traditional markets. It's a really compelling story, but is it actually true? Let's find out.
Okay, so here's how we're going to break this all down. First, we'll get into that whole digital gold idea. Then we're going to throw it into the ring with 3 major real-world market meltdowns. After that, we'll look at what the hard data says, the correlations. Then we'll dig into why crypto acts the way it does. And finally, we'll reach a verdict. Ready? Let's do this.
So let's start at the very beginning. What was this digital gold thesis all about? What was the big dream that got so many people excited?
I mean, you can see the appeal, right? Just imagine an asset that doesn't care what central banks are doing or what's happening with politics. It was sold as the ultimate financial lifeboat, the perfect way to diversify. Sounds great in theory, but a theory is one thing. What happens when it meets reality?
Yeah, talk is cheap. The real test of any investment is how it performs when everything hits the fan. So let's look at what actually happened during some of the market's worst moments.
And we've got 3 perfect recent examples to look at. And these weren't just little dips either. These were moments of pure, unfiltered panic in the markets. The exact time a safe haven is supposed to do its job.
First up, March 2020. Remember that? The whole world just stopped? The pandemic kicked off this global panic, a desperate dash for cash, where investors were selling pretty much everything that wasn't nailed down.
The S&P 500, the foundation of the U.S. stock market, basically fell off a cliff. It dropped a massive 34% in just a few weeks. It was a complete bloodbath.
So, did crypto ride to the rescue? Not even close. Bitcoin actually fell harder and faster, losing half of its value in just 2 days. That's not a hedge, that's an accelerant. It was like pouring gasoline on the fire.
Okay, next up is the slow-motion train wreck of 2022. This wasn't a sudden shock, but more of a relentless grind. Central banks decided the inflation party was over, and they started jacking up interest rates, squeezing all the easy money out of the market.
And in that world, what's the first thing people sell? The riskiest stuff. Bitcoin, our supposed digital gold, got absolutely hammered, plummeting 65% from its peak.
And it wasn't an isolated incident. Ethereum and other cryptos got hit even worse, some losing nearly 70%. So, once again, when investors needed an umbrella, crypto was the storm.
Now our final test case, the big crypto rout in late 2025, really pulled back the curtain on a fatal flaw in the system: leverage. This is the hidden danger that makes crypto so fragile in a crisis.
Just look at this number, $19 billion. That's how much in leveraged bets were just erased in a single day. This wasn't just nervous selling. This was a forced liquidation cascade, a death spiral, where falling prices triggered even more selling, pushing the whole market right off a cliff.
So the stories from the front lines are pretty grim. But that's just a few moments in time. What happens when we zoom out and just look at the hard data? What do the correlations tell us?
This chart says it all, really. Before 2020, you can see that crypto and stocks kind of did their own things. The correlation was low. But look what happens after that. During every single crisis, the correlation skyrockets. They stop being separate assets. They become joined at the hip. And when stocks fall, crypto falls right along with them. So here's the bottom line. A true hedge is like an airbag in your car. It's supposed to protect you in a crash. But based on its behavior, crypto has been more like a faulty ejector seat, launching you out at the worst possible time.
And this brings us to the big question, right? Why? Why does an asset that was born to escape the traditional financial system seem so hopelessly tied to it when things get rough?
Well, the evidence points to 4 big reasons. First, crypto needs a constant flow of new cash to keep prices up. And in a crisis, that cash just dries up. Second, its value is based on stories and sentiment, not profits or assets. When fear takes over, that sentiment can disappear overnight. Third, like we saw, the market is swimming in leverage, which creates those awful death spirals. And finally, the big institutional investors, they don't see it as a safe haven. They see it as a super high-risk tech play, and it's the first thing they sell when they get nervous.
Okay, so let's put this all together. We've looked at the big idea, the real-world tests, the hard data, and the reasons why. It's time for the verdict on the whole digital gold thesis.
The evidence is pretty overwhelming. Historically, crypto hasn't been a hedge. It's acted like what investors call a high beta asset. Just think of it like a tech stock with a rocket strapped to its back. It flies higher when times are good, but when the market turns, it crashes and burns even harder.
This quote from one analysis just nails it. Crypto has functioned less as a hedge and more as a leveraged proxy for risk appetite. In plain English, that means it hasn't been a tool for protection, it's been a tool for speculation, a bet on greed.
So, is that it? Case closed? Well, maybe not entirely. The past isn't always a perfect predictor of the future. It leaves us with one final thought. Could crypto ever grow up and evolve into the true hedge it was always promised to be? Or is it just destined to be a roller coaster for risk takers? For now, that remains to be seen.